The market is a roller coaster. One day up, the next down. But you know what keeps climbing no matter what? My dividend income. And another thing that's growing, this community. So if you're new here, hit that subscribe button and join the journey toward financial freedom. And if you're already subscribed, drop a hi in the comments. Today we're diving deeper into my 117k dividend portfolio. Breaking down my holdings and their performance. Keep in mind that this and part 3 were pre-recorded, so some numbers may be slightly off due to market movements, currency fluctuations, and my regular buying and selling. But don't worry, you will still get a great overview of my portfolio. With that said, let's jump right in. Position number 20. Aker BP, a Norwegian oil exploration and production company with a strong focus on offshore assets in the North Sea. The company is known for its efficient operations, strong balance sheet, and commitment to shareholder returns through dividends. With its focus on both traditional oil extraction and low-carbon initiatives, Aker BP is positioned as a key player in the European energy market. Here, I have invested 2.22% of my capital. It's a pretty new holding along with Vår Energi from last video. And what can I say? I really love the high dividend here. And since Aker has been around for a while longer than Vår Energi, I have a bit more money here. The yield on cost is 12.37% and the yearly income sits at roughly $268. My total return is 5.5% so far. While energy remains a strong income source for my portfolio, I also like to invest in companies driving the future of transportation. That brings me to position number 19. Volvo AB, a Swedish multinational company specializing in commercial vehicles including trucks, buses, construction equipment, marine and industrial engines. Volvo is at the forefront of innovation in electrification, autonomous driving and connectivity, making it a key player in the global transition to sustainable transportation. The company has a strong history of profitability and shareholder returns through dividends. Here is a company I sometimes just forget. They keep chugging along and it's very hard to get them at a cheap price. I have 2.25% of my invested capital in Volvo. They usually pay a regular dividend and special dividends every year. Counting in the special dividend for this year, my yield on cost is 10.02%. Very nice. They pay me about $223 per year. My total return is pretty decent, sitting at 94.58%. Now shifting gears from industrials to healthcare. Let's talk about the next one, a leader in biotech and innovation. Position number 18. Amgen. One of the world's largest biotech companies. Amgen is focused on developing innovative medicine for serious diseases, particularly in oncology, cardiovascular health and autoimmune disorders. Its strong product portfolio includes blockbuster drugs like Enbrel and Repatha, and the company continues to expand through acquisitions and pipeline development. Amgen's stable cash flow and commitment to returning capital to shareholders make it a solid dividend stock. Ah yes, the classic move of buying too little. I wasn't liquid at the time, and I didn't want to take from my savings account, since I thought they would drop more. But surprise, surprise, what do you know? The total opposite happened. So, my invested capital is 2.35%. My yield on cost is 4.29%, with some decent growth of between 8 to 13% per year when looking at the 3, 5 and 10-year compounded annual growth rate. That shows you can get an acceptable dividend yield with a strong growth. My income each year for now sits at just $95. What makes up for it is my total return of 46%. If the price continues to climb, I might sell this one. Healthcare is a key sector for long-term stability, but another essential industry is the energy distribution. Time for another energy company. Position number 17. Rubis SCA. a French energy company specializing in the storage, distribution and trading of petroleum products, including liquefied petroleum gas, fuels and bitumen. Rubis has a diversified presence across Europe, Africa and the Caribbean, ensuring steady revenue streams. Its business model is defensive, benefiting from long-term contracts and essential energy needs, which supports the consistent dividend payments. You just gotta love the energy companies. It's a relatively new position as well, 2.4% of my invested capital, and I actually got to enjoy a special dividend this fall, but they only pay once per year, and that is in June, so I'm still waiting for that first UC payment. My yield on cost is 8.34%. Oh, wait, hold up. They announced a dividend hike this week, pushing the dividend from 1.98 euros to 2.03 euros, making my yield on cost 8.55. And that's their 29th year of consecutive dividend growth. Dividend income per year, $221. And the total return is 11.13% right now. Speaking of established businesses with steady cash flow, let's talk about the next company. A company navigating the transition from traditional tobacco and reduced risk products. Position number 16. Philip Morris International. A global tobacco giant, best known for its Marlboro brand, but increasingly shifting towards reduced risk, smoke-free products like the IQOS. PMI's strategy revolves around transitioning smokers to alternative products while maintaining a strong profitability from traditional tobacco sales. Its strong cash flow and commitment to dividends make it a popular income stock, despite regulatory challenges. Now, the so-called sin stocks are my favorites. Usually, they are hated by everyone, so they usually have low valuations and high dividends until they don't. You will see. This is 2.47% of my invested capital. The yield on cost is sitting at a nice 6.02%, and it's making me $172 in income per year, also with some decent growth. Let's talk about total return here. I've been collecting around $452 in dividends through the years. Combining that with the current value of my holding, I'm up 91.8%. I do, however, think that they are pretty overvalued, but since the dividend is nice, I'm holding and waiting for the price to come down. Strong cash flow and reliable dividends are important in my portfolio, and the financial sector is another great source of both. Enter position number 15, Manulife Financial. A leading Canadian financial services and insurance company with operations spanning North America, Asia and Europe. Manulife offer life insurance, wealth management and retirement solutions, benefiting from long-term demographic trends. The company has a solid capital position and a track record of increasing dividends, making it an attractive choice for income investors. I bought this company in early 2023 and I liked their business model and their strong growing dividend. But as you can see, things have gotten out of control. It's 2.61% of my invested capital. The yield on cost is 6.16%. The yearly income is $144 and my total return is 60%. Financial security is key, but so is food security. That's why I also invest in the next one, a leader in grocery retail. Position number 14, Ahold Delhaize. A Dutch multinational retail company operating supermarket chains across Europe and the USA. Notable brands under its umbrella include Albert Heijn, Stop & Shop, Food Lion and Delhaize. Ahold Delhaize benefits from a strong market positioning in essential consumer goods, steady revenue from grocery sales and digital expansion strategies, all of which supports its stable dividend payouts. Yes, another grocery retailer. I like to invest in essential businesses and boring businesses. 2.74% of my invested capital, and this is a free cash flow play with a good and growing dividend. 4.37% yield on cost, and a yearly income of $127. My total return is 23.58%. Retail is an ever-evolving space, but so is technology, and the next position has been a consistent player in that field. Position number 13. HP Inc. A technology company primarily known for its personal computers, printers, and related hardware and services. HP benefits from strong brand recognition, cost efficiency, and a strategic focus on recurring revenue through printing supplies and managed services. Despite the competitive market, HP remains a strong dividend payer with a history of share buybacks and capital returns to investors. I mostly bought HP for their strong cash flow, but also their low payout ratios for the dividend. So I believe they will be able to hike that dividend, even in tough times, as they have been doing. 2.86% of my invested capital. The yield on cost is 4.28% and the yearly income is $147. The total return is 6.5% following the recent drop, which have made them pretty undervalued, so I might add to this company. Individual stocks are great, but as you know by now, I also like to diversify with ETFs, especially with covered call style ETFs. Position number 12. Montrose Global Monthly Dividend MSCI World ETF. An exchange-traded fund designed to provide stable monthly income by investing in a diversified portfolio of dividend-paying stocks and selling covered calls to make additional income. This ETF sells covered calls on the MSCI World Index, making it an attractive option for income-focused investors looking for passive cash flow. Look at that, another covered call ETF. Yes, I know. But this one is a bit different though. Since the dividend and the share price is in Swedish crowns, I don't have the currency risk. It's a brand new ETF and I'm planning to average into it. It is 2.9% of my invested capital. They aim to deliver at least 6% yield, with 2% coming from the underlying companies and 4% from covered calls. My income is estimated to be $175 per year. The total return is awful right now, but I imagine it will look better over the years when I keep stacking those dividends. And finally, another essential industry that often goes under the radar is food, ingredients and commodities, which is where the next one stands out. Position number 11. Akumo, Amsterdam Commodities. A Dutch trading company specializing in food ingredients, spices, tea, edible seeds and nuts. Akumo plays a crucial role in the global food supply chain by ensuring a steady flow of agricultural commodities. The company's focus on essential food products provides defensive characteristics, and its consistent earnings support a strong dividend policy. This is really an under-the-radar company. They just announced a dividend hike of 9% from 1.15 euros to 1.25 euros. I got 3.19% of my invested capital here. With the new dividend, my yield on cost is 6.21% and my yearly income from Akumo is $191. My total return is sitting at 8.9%. This is one company I'm going to add more to in the coming weeks. Alright, that's it for this part of my portfolio reveal. If you enjoyed it, smash that like button, subscribe and hit the notification bell so you don't miss the final part. And now, I want to hear from you. What's the best dividend stock in your portfolio right now? Drop a comment down below. With that being said, I'm the Swedish Dividend Investor and I will see you in the next one. Stay smart, stay patient and keep stacking those dividends. Ha det gött!